Good morning or good afternoon, everybody, depending on where you are. This is Kevin Kehoe. I'm on the, well, not exactly the West Coast anymore, California, but Arizona. And I'm here with John Gohl of the Aspire Software Company. John will do some facilitation of any Q&A. We have a fairly large audience, so doing some Q&A is going to be relatively difficult, but we'll give you some options for follow-up after this webinar. And I'm going to give our audience about a minute or so to organize, get themselves online completely here. So you may hear a little bit of silence for a moment here as we get going. However, in advance of that, I would suggest that a couple of things for ground rules. We'll do a survey near the end, as we'd like to hear from you about desire for future more details. As a matter of course, you know, in 45 minutes to an hour that we have today, we can't cover everything in a large amount of detail. Nor are we suggesting you do everything we say you do. I think what's critical here is understanding the current situation. Secondary to that is what you do about it given your current situation. So I want to share as much information as I can in the next hour or so. Of course, we're not the only ones doing this. There's a lot of people doing webinars and etc. We think it's important, for our clients of the Aspire Software Company, obviously, but as I've been in the industry for more than 3 decades and have lived through more than a few of these things, the industry is important to me, obviously, that we all do well given what's going on. So keep that in mind as we go through what we go through today. One other thing I will mention before we start here is that there are a number of different documents that I'll be referring to today, including the PowerPoint slide deck here. We'll make those available to you also, so you have that. So, hey, John Gohl, maybe you can make sure everybody is muted, watch the question board, and we'll get going with today's webinar. So welcome, everybody. I call it Surviving This. I'm the founder of the Aspire Software Company. And is it unprecedented? No, but what is this, right? I mean, this is, let me get my slideshow working, right? This is what we're facing at the moment. And there is the disease and the virus, but there's also significant economic impacts and consequences. The question is that we want to answer today is the following. You know, what do we think is the most likely forecast given what we know at this point in time? Again, very fluid situation. And then given this, what might you do to address this from a business person's point of view? Sources of the information. Me, obviously, 30 years in the industry, so some of this is based on my knowledge. Second, I've interviewed quite a few CEOs over the past 10 days or so in the industry, people I know, people I think run great companies, and those people manage over $1 billion of landscape. So I think it's a significant sample size that informs some of what I'm about to share with you. And then precedent. This has happened before, it's not the first time, right? There's some things that we can learn from history about this that I think we can apply today. First of all, let's just deal with what I consider the forecast. There are really 3 pieces to the forecast. In other words, what's going to happen. Certainly the duration. When I say duration, I mean duration of the government rules in terms of sheltering in place, industry shutdown, etc. That's going to be critical and key. Another thing affecting the forecast and what you might do is the underlying fundamentals of the economy. And the third piece is comparison to other scenarios and situations, if there's something we can learn and then apply to that forecast. Speaking to the first, duration. My guess, and this is based on again, so many data points in a fluid situation, is that hopefully by the end of April, we're back to work again in some way, shape, or form. Certainly not 100%, certainly not all at once. And given the nature of what's happened thus far, the recovery is not going to be immediate. It's going to be slow, as a fair amount of the damage economically has already been done. And I'll get into some details on that. Second, the economy, that's much better news in my estimation. Comparing it to 2008, for example, right, which is another data point, where back in those days, I was a consultant. I started the Aspire software company 2014, which really was pretty much the tail end of the 2008 to 14 economic slowdown, although there was life by 2012. If the economy was a patient, then it was on the operating table facing an operation and a long recovery. Today, the patient has been sent to their bedroom without dinner and forced to be locked down for a while. So the underlying economic fundamentals in terms of capital availability, low interest rates, consumer confidence, at least up to this point, demand for services and spending have all been good. None of that was true in 2008. So our best sense is that in the next 30 days, we'll get back working to some extent, but that the 2020 year is going to be significantly affected really to the end. So let's talk about what those revenue, overhead, and labor impacts are. And by the way, right, these form assumptions for figuring out the math, right? Because you understand the math of what's happening, then you have to apply it to really two things that you deal with every day, right? It's your profit and loss statement and your balance sheet. And both of those come into play. The interesting thing that's sort of changing the dynamic today versus then is the level of government attention, or how do you say, getting into and helping in the scenario. So number one, contracts. 10 to 20% down for most people, at least that's the forecast. And essentially, it's different than 2008, where contracts were canceled and pricing was the big one in 2008. People wanted price concessions, some of them super significant. Really what's happening is a cutting out, reducing a scope, and that reduction of scope is very specific to the segment. I'll show you that. Enhancements, 20 to 40% down. At least that's the anticipation of many people. Again, some of that's going to be a function of the segment in which you're operating from a maintenance point of view. Construction, really big differences here between commercial and residential and spring and fall seasons. First, commercial. Because of the bidding cycle and the doing cycle, if you will, right? Day from bid to day that we start work in construction, right? You're often bidding 6 to 9, 12 months in advance of the work actually happening. That's not the case with res, right? Res, you're bidding in March to do work in April. And so that means the spring is going to be super tough for residential, as the phone is simply not ringing, which means residential, as we'll talk about in a moment, really has to focus on fall work. I'm not saying you give up on the spring, but it's obviously already April. Commercial, quite the opposite. There is still commercial bidding going on. There is, in fact, a fair amount of commercial work being done because it started or has continued from 2019 through 2020 thus far. What's more concerning, if you're commercial construction, is the fall. Will the work that's being bid or let today actually be pushed into 2021? And there's a suggestion that that's not unlikely. Of course, the timing for us in this industry is like Black Friday is for a retailer. If a retailer misses Black Friday after Thanksgiving, you wait till next year to pick it up. For us, a lot of similarities there, especially when you look at cutting scope on contracts for mulch or spring color, et cetera. That's not coming back, right? There's no way to recover that. So there's going to be some timing impacts, which are, as you're going to see as I show you in a moment, are going to probably affect the rest of the year for most of you. Impact on contracts, right? Really two things, at least what I've been hearing from all the people I've been speaking with, and a lot of our clients, is where the segments are going to be most affected negatively, and why. And why is typically, is it an optics or is it a pain? Pain, right, is very specific that the client does not have the money because their operations have been financially affected. Optics is, it doesn't look good for us to spend money on things, right, when we are cutting back on other things. So for example, if I'm laying people off, I'm not going to do spring color and mulch potentially because that just doesn't look good. And so, and some of this may seem, I'm not sure it's obvious, but certainly you're experiencing it, is some of the most negatively impacted pain scenarios, of course, or segments are retail, restaurant, as they're shut down, resort, hotel. HOA and commercial fall more into the middle level in terms of pain. Some of it I heard from some account managers I've spoken to, they simply can't get decisions out of boards for HOAs because they're not meeting in the same room. And commercial operations, people are at home. And so some of that impact on those segments, likely less, at least that's the consensus, and more not because they lack the money, but because the optics, they don't spend it. So if you're 100% an office park, warehouse, industrial, your contracts may not be affected terribly much. Doesn't mean they won't, it just says it's less likely. So if you just, for example, model that out, right, as I said, do the math a bit, what does that feel and look like? And this is going to start leading into some of my suggestions about what you should do. And some of what you should do is based on what's worked before. And I'll explain that in a quick moment. So let's look at this modeling left side, right? Here's a company that does $3 million with its contract and enhancements broken out this way. And that 10% reduction, 30% reduction, just as a what if, right, would produce that type of revenue scenario, right, which is, we're all working on budgets, hopefully, which is 15% down. Now, the other data points I always looked at to manage in a crisis were obviously not just the revenue, but were the COGS, cost of goods sold, specifically labor. And in labor, there are two variables I'm managing, which is the hourly cost of that labor, AWR, average wage rate, and then the hours associated with that number. So our scenario here says that this is a 48% gross profit business, right? That's the target goal. Cost of goods, this number obviously includes labor and materials and subs. This overhead is what we budget, right? 38 cents on the dollar, 1.14 million. And this assumes a 10% budget profit company goal, if you will. And keep in mind, right, that this 10% is before debt service, right? So this is not a cash number. This is a number that's a profit number, and debt service gets subtracted from that number. So as we see in a moment, this becomes a pretty important thing to consider. Now, if you just look at what happens here, if I were to remain a 10% company, in other words, I've given up, right, a fair amount of that number here, the 300 to get to here, I still have to pay that because that's fixed. I'm looking at reductions of 15,000 hours and $175,000 in overhead spending. Okay, where the heck do you get that? Well, that's part of the plan. That's part of what we want to talk about. That overhead piece, if you boil it down, one more piece. And again, I like doing the math because it tells me how much and where I need to make efforts to change things. And as unfortunate as this is, I think the same thing happened in 2008, which was after a great run up from 04, 05, 06, 07. People get a little bit sloppy in their discipline about watching labor hours, about buying, about estimating, about managing overhead and cost. And none of that obviously works in a downturn, but part of it is changing the mentality from we were a little bit sloppy because revenue solves a lot of problems to like, we can't really be sloppy at all. I mean, discipline is going to be required regardless, right? Regardless of how much the government helps. And so if we just take this apart a little bit, right? That dollar of revenue, 52 cents is the cost. There's your gross margin. There's your overhead, 38 cents on the dollar. And here's where it gets a little bit sticky, because 15 is equipment, right? That's your depreciation. That's your shop people cost. That is your parts, pieces, repairs, your purchases, replacements, right? 15 cents on the dollar typically for most companies. People, right? This people is your overhead staff, everyone who's not in the field, production people, account managers, sales, BD, business development staff, owner, manager, admin people, right? That's 14 cents on the dollar typically. So 70% of all the overhead that you might cut, right? And if I go back to my number, right? That number there, which we'll come back to, there's only a few places you get that to maintain a profit margin. So that gets back to our next impact area. So revenue is one area impacted rather significantly. Overhead, I think, also. And so we're going to have choices between cutting cost, people, or paper clips. I'm not trying to be terribly glib, but you saw how much of the overhead is people. And so there is some discretionary spending to be cut. And I think there's probably some of that in marketing, but most people's marketing budgets aren't that great. Most of that other overhead that's not people or shop and equipment is rent, utilities, insurance premiums, things of that nature, which are relatively fixed. Doesn't mean there's not places to manage or cut that, but you got to consider managing the big dollars in an overhead forecast potentially significantly. Again, all this is a function of duration. Again, I'll go back to our sense. If we're back working to some extent by April into May, 2020 is going to be impacted the way I'm talking about right now. That's not going to change. It's not going to magically get better. And so you're going to have to deal with overhead in my estimation. If for nothing else, for more than survival, is to get back to some level of discipline. And we'll talk about that. Forecast labor. Well, revenue's down. Labor supply, according to most of the people I've spoken to, is not the primary concern. Another thing that's changed dramatically since 2008 is that most of the 2008 financial success was built on a very vibrant construction market. Today, 2014, success for most landscape companies is rather balanced across the board. It's not driven by construction alone. It's driven by contract growth, relatively solid pricing on those things, and significant enhancements. So even if revenue is going to be down to some extent, it's not going to have the same crippling effect as construction that disappeared back in 2008. So that means the availability and access to labor seems to be less critical. What becomes more critical, at least according to the folks I spoke with, is retaining some of your key talent, right? Depending on how bad your revenue decline gets, there is some level of fixed cost component to maintaining cost of goods sold labor, right? Non-billable hours, it's called, by keeping key people, because I don't want to get rid of those folks, because when things come back, I'm going to want them and keep them. Plus, there is an element of loyalty, and I'm a big loyalty person also, about keeping key people. So I think that's a critical thing to look at, is who you retain. And number three might be obvious, is efficiency. And this is all about software, is being able to manage everything from the estimate through the work ticket and schedules down to payroll, such that every property, every job is being done at or better than budget. And then the last piece is there are some government compliance requirements, and we've got some of these posted on our website. We'll make those available to you. But you're having to put one person in a two-person truck, two people in a four-person truck. There are a number of other things that are going to have an impact and a cost impact. But again, this one feels relatively less critical than the other two, the overhead and the revenue. impacts and how we deal with those. So let's talk about what we do. And allow me to preface this as follows. And this was my experience and my client's experience in 2008. We had what we felt like was a very specific set of strategies, which I'm going to share here, which apply today. Maybe not all at the same level, maybe not even all I have to execute depending upon duration, but every one of them should get into the plan or into the thinking somehow. And one of the things that I felt was always number one in any crisis situation is you have to manage fear. And what I mean by that is people don't know things, and people who don't know things make bad decisions and assume the worst. The worst for most people is losing their jobs because of what's going on. And so being very clear on getting out in front of that means you need to know things to get all hands on deck. And so what that means is not just the psychology or a nice talking point. We ran everything on what we call 30-day budgets. We of course, based on what I just showed you on the remodeling, is we have to redo the annual budget now, but we ran the company to keep everyone in on things and focused on 30-day budgets, very detailed 30-day budgets. And here was the biggest problem back in 2008 that I found, and I think to some extent why I started the Aspire software company. I couldn't get my hands on the bloody data. We couldn't find stuff. There were contracts on spreadsheets, on folders. There were work tickets or bids in different places that different people were maintaining and managing. It was just hard to get good data, and you need good data to make good decisions. Let me describe what we meant by a 30-day budget. And we did this as a group and a team and communicated it. We want to know for the next 30 days, what revenue are we going to produce and invoice? And what's our current AR, what we feel is going to be collected, right? That's our step one. Most importantly is what revenue are we going to do? And that revenue is always associated with labor hours. So every service, right, when you're rescoping a contract or you're producing a construction job, right, each of those has services. And in the Aspire world, right, or other software worlds, we call that a work ticket, right? The work ticket allows you to do a very accurate forecast. So I could go in and look at everything that I anticipate being done in that 30-day period and the amount of hours I think required, or the estimate says to do it, as well as that revenue. Of course, I'm going to have to confirm that, as we see in a moment, with my clients and customers. So the biggest challenge sometimes to getting all hands on deck is accurate information. And instead of taking 2 to 3 days to gather it all and then it all changes, is being able to get at some very simple information quickly. I always found that 30-day budgets accomplish that goal of minimizing the fear and the worry, because what you don't know sometimes is scarier than what you do know. As long as you understand the extent to which you have to respond, then every other decision from that flows. So 30-day budgets, essential. Action 2, liquidity. This is obviously super critical, and if you're an accounting person, you would probably make this action 1, which is to maximize liquidity. Liquidity, in simplest terms, is cash. And there are 3 sort of cash cycles that we always focused on. Cash in, cash out, cash bridge. Cash in, right? What cash in is a function of the 30-day budget. What do we anticipate, planning, forecasting, what we're going to bill, and we always focused on accelerating the billing cycle. So we billed as close to work completion as possible. We didn't wait to the end of a week or the end of a month. You obviously have your regular first or middle of the month contract billing, but everything else we try to bill immediately when done on completion or at hitting a specific milestone in the construction or the enhancement job. And then receivables. Receivables is what I call an all hands on deck scenario or situation. We made the management of the aging report everybody's job, and we assigned accounts to admin people, account manager people, owner, sales people even, to very nicely follow up on all those accounts receivable. And of course, if you can get people these days to do actual payments online, it makes accounts receivable a moot point, which is a smart thing if you've been moving in that direction over the past year or so, is posting your invoices online and collecting payments, either cash, credit, or ACH. The second, of course, is slowing down the cash out, which is purchases, inventory, and payables. With good data based on the forecast of revenue that also shows you your labor, it also should define your purchases. So having the data to look at what's required to be purchased, what's currently in inventory, is critical to minimizing the cash out and making unnecessary purchases. That, of course, gets tied to the accounts payable, which really becomes more of a relationship issue. Your vendors, your subcontractors are trying to do number one, right? They're practicing cash in. You're trying to do number two, cash out. This will end one day. And so getting terms for 45 days or 30 days versus 20 or 45 versus 30 becomes a conversation. And in my mind's eye, you never not tell your vendors and your suppliers that you're slowing down payments. You work with them, right? Because that pays off later on. It's just good business in my estimation. Cash bridge.
Hey, Kevin, I'd like to interject for a second regarding purchasing. I'm certain there's a lot of credit cards floating around throughout these organizations. Could you kind of talk about how you would address a good purchasing process for companies?
Yeah, that's a good point, John. I'm getting to that actually coming up.
Okay.
A slide or two as one of the things that we should be doing, but it is critical. Cash bridge, line of credit. Line of credit, if you don't have one, you get one. And if you have one, you use it. We always used it in times of crisis for the very simple reason that we're trying to build a relationship with our bank. And sometimes even if we did not need the money, we borrowed it because the rates were low enough and we paid it back rather quickly. That established two things for us. One, that we're a healthy business with the bank. And number two, that they like us as a client and customer because they actually make money on us. So part of the working with the banks and liquidity, right, is number one, starting at the line of credit. And then number two is your balance sheet. Balance sheet is critical. In 2008, a lot of my clients had very difficult times because they were in debt because they were growing. And then since construction was the big business then, when it halted, and it almost fell off a cliff, if you recall, many got stiffed by big developers for millions of dollars, right? And as I said to my clients then, I can help you fix your P&L income statement in a couple of months, but a balance sheet takes years to fix. So number one is long-term debt. Going to the bank then, along with line of credit, is looking at your long-term debt and debt service in relation to your new modeled P&L for the year and looking at interest rates and terms. The second is SBA. SBA is doing some interesting stuff, and I'll make this available to you. But this is the Coronavirus Emergency Loan Small Business Guideline and Checklist. It's a 4-page document. We'll post this, but it talks about SBA and their new relaxed guidelines, formulas, as well as accelerated process for, well, making your balance sheet better, right? Helping you tide over. Because even, as I said, if we get back to work in May, balance sheets are going to be affected till next spring. So who's eligible? It's got a list of the eligibility, right? Who's eligible? Even self-employed people, right? Carrying on a trade or business. And landscape is a business that is considered an essential business, right? That is also part of the documents that we have. So if you're under 500 employees, which most of you probably are, right? They tell you what the vendors are looking for. They also give you a formula, which is really interesting, right? About how much you can borrow. And there it is. I won't go into detail on this, but it gives you an idea that there is an option out there when you're looking at your balance sheet that the SBA is at least entertaining, right, and making available to you. And so, again, in a situation scenario like this, I try and look at everything, right, as options, and especially if the balance sheet is critical to managing in the long term, because it doesn't hurt today, it hurts tomorrow, right? It affects your 2021 ability to do business because your debt service, right, is significant in relation to your cash flow. And then government legislation, the CARE, I'm going to go into that a little more detail in a moment. Action 4, sales. I never fired salespeople. If they're good, they are sometimes your best communicators. Some of them are your best workers. It's not suggesting that the others are not. But the one thing I never sacrificed was any dollars in overhead to spend to go get new sales. However, I always wanted to make sure that we and our clients were focused on doing that efficiently. And so we had two concepts we used. They're called scrub and prospect. So scrub, and again, this was part of our 30-day budgets. You know, having a pipeline of contract work that you want or you're bidding, right? Because anything in a pipeline is what you're bidding right now. It's what we call an opportunity proposal, whether it's construction or maintenance, is we did a reality check every 30 days on that pipeline. So opportunities could rotate, the same opportunities could rotate in or rotate out of our 3-column approach. And we did 100%, 50%, 0% rating, right? With the salespeople and everybody in the room who was associated with the pipeline. 100% was that opportunity in the next 30 days, we're going to close it. 50%, I don't know, don't have enough information, kind of a maybe. 0, nah, not in the next 30 days. And our rule was, of all the opportunities, only 10% could go in the 50% column, right? Because otherwise everything ends up in the 50% column. What you find out pretty quickly is there's not a heck of a lot in the 100% column, typically in a 30-day forecast. Some months better than others. And so that led to a very simple set of actions, which was go after those 100% and get that signed, right? That you said it was going to close. Prospect. In a software like Aspire and others, this is now going into your CRM, part of your system, and this is this wish list. And this was something that was good practice. We felt all the time that now when you needed it, it was now available to you, was these are the properties we wanted. We bid them before, we maybe had them before, we have looked at those, right? We want to reach out to that property list, right, via email, phone call, and potentially a visit with a very simple message. The message is, we're here, and this is what we're doing with our clients to do two things: to manage your cost as well as the overall value protection of your property asset. So if you're interested, you want to talk to us, why don't we get on a call, right? And so we refocused the BD salespeople to scrub and work on what we knew. And then second is to go after the others. That may sound a bit harsh, but what and still to today amazes me a bit is how little sometimes, or how infrequently, contractors reach out to their own prospects and clients to give them any information or news at all. And so the clients, the prospects, are flying in the dark. We wanted to, from a new sales point of view, do precisely the opposite. We want to let people know we're there, and here's how we could potentially help you. You're going to see in a moment I'm probably also redeploying my BD salespeople to do some other work on action number 5, which is customers, right? What I just alluded to, which is to reach out to the clients. We would focus, and again, all and every action I'm talking about here, you may not do all of these. Some of these may be more critical for you, given some of the underlying assumptions about how impacted your revenues are and your overhead. But we always kept an ABC list, right? C are your quote worst clients, and worst, you have to have a definition on that, but typically they were lower margin, higher maintenance. A's and B's, right? Those are the better ones. And so that's a simple property list. And so we would divide up the work amongst business developers, account managers, owners, and people who would get which part of the list. And we would go to them via phone, via email, face-to-face, and we would practice what we called the 3 R's: retain risk, rescope, rebudget, reassure. What we clearly want to know for every one of those people, regardless if they're A, B, or C, is what's the risk of them canceling completely? That would potentially then lead to rescoping. How can we rescope your maintenance contract or current services that you now have under signed contract with us if you want to do that? Third, rebudget, right? Because rebudget is broader than rescoping. It's all the potential spending a client, a property may do for enhancements, for optional contract services, et cetera. And we would focus on completing a best and worst case scenario for that customer, for that property. And then we would work on reassuring. Reassuring this is what people often don't think about, is that when you reduce short-term maintenance services, you increase long-term risk to the value of that property. In other words, deferred maintenance actually has a cost. Now, it's not perfect, but if the duration is significant enough, we ultimately started lopping off C customers or reprice them, and most of them would not take a reprice. That left us with the A's and B's, right? And it's fascinating to me that by paying attention to your clients, how much more you reassure yourself that you're in fairly good position, but how much better the clients feel, and you get a reality check that will help you do your 30-day forecast when you have to continually reforecast revenue, which you're going to have to do for April, May, June, July, August, September, the rest of the year. If nothing else, right, we know how many C people we can get rid of. We never did that immediately because there is still some revenue coming from them. But if we looked at retain, rescope, rebudget, reassure, and it was even worse than we thought, then we definitely got rid of C clients. Which brings us to what John was talking about, organization. And this is overhead, action 6. Very similarly, we had an ABC list of our staff. And even going back in 2008, I never suggested to any of my clients that we reduce spending on anything like software technology that was available at the time. It sounds terribly self-serving to be an owner of a software company and say this on a webinar, but it's so true, because once you get into laying off, furloughing, firing, the people left have to do the work. They aren't terribly happy about that, especially if you're entertaining number 3 there, right? Salary reductions. And I think you have to have a plan for that, right? So there's a plan for who we lay off when, right? The C people. I didn't say it was fun. I just said it's essential, right? Because liquidity matters. And a lot of your liquidity is expense going out the door in payroll. One thing I heard, which was interesting and may not apply to you on this call or everybody else, was 2019 was a good year, and a lot of people earned bonuses, which the bonuses for many of these people are being paid like right now, February, March. That's a good thing, and you may in fact not want to do that if you reconsider some of that, if you haven't done it yet. I'm a bit, again, anything to maximize liquidity says I might hold off on that, or depending upon how bad my revenue impact is, I may indeed pay that and then come up with a salary reduction plan. And the way we did salary reduction plans was, you know, those who might have been paid 30 or 35,000, we typically did not touch their salaries, but those making 80 or 90, right, they might have the biggest potential salary reduction. And then we'd have to work that in over a period of time based on our 30-day forecast. The whole point with that is people know, right? I have a job, and potentially I may have to have a salary reduction if the following things happen, right? All hands on deck. That leaves us really with what John was talking about, where the real other money exists aside from discretionary spending, right? Is CapEx, shop expenses. 15% typically of your budget every year is wrapped up in some way around vehicle fleet equipment. And that gets to the purchasing process, which was, except for fuel cards, we collected every credit card from everyone except for people who were and had the right and the permission to approve purchases of a certain level. So we established a hierarchy that most purchases had to go through a requisition process and had to flow up to the owner or the controller to decide whether we made that purchase or not. And this is based on just some simple math that often the buyer is not motivated by price or even to look and see if it's essential. They're motivated to get something done. Whereas the owner, the controller, is definitely motivated by liquidity. So we would put in place purchase processes, and you know, there are two types of purchases, right? There are those related to the work being done, right? Those are part of the work tickets and required for the work to be done. And that then fell into that category of working with our vendors on pricing, availability, and payment terms about with whom we do business for that actual cost of goods work. And then all the other purchasing is related to, and quite a bit of it, folks, is related to shop equipment and tools. And we shut that down pretty tightly. We certainly didn't let the gal, mechanic running the shop be in charge of that. And so controlling purchases at point of purchase is critical in our mind's eye. And we did that for as long as we felt we needed to. The overall impact of all this is transparency. If nothing else, in a situation, call this a crisis, it is in my mind a bit that this is, and there are only certain things you can control. We may or may not agree with how things are being handled, but that is the way they are. So what I can control are the things I'm mentioning here. And I want my people as a leader to know what we're doing as honestly and directly and as forthrightly in the time available, what we're doing and why we're doing it. I think that's essential for any leader in a crisis. So now if you really get down to some of the details again, it's if we, again, using my example, bought into this scenario, that's the amount of money I'm looking at to cut out of my spending through people, salary reductions, CapEx suspension or replacement purchases, and our purchasing process, right? To at least find somewhere we could do this without impacting that number. Again, that becomes an important number to deal with. And there is some help in that regard with the government care program, which I'm going to share with you in a moment, what we know right now on that. Construction. As I said, there is still construction going on, certainly on the commercial side, for the spring. And so we had a point of view about construction, whether we're in the DB world or what I call BB, bid build world. And this, again, is where software and data becomes critical, is we would daily whip everything. Every job, we would look at what the bid was, how many hours have been thus far, how much material has been thus far installed onto that job. Are we thinking we're over, under where we currently are? And then what's remaining in our mind's eye to get that done, right? One thing we certainly know, or my experience has been, is that change order management is loosey-goosey at best. And this is particularly true on residential DB, where things change all the time based on an owner's whim or a change in their sense of how the job should go. And that change order management, by the way, is about scope, right? What's the scope of the job? Scope management on construction is typically much easier to see, as it is quite detailed, and there is typically a process for doing change orders. But my sense was, in addition to the 30-day budgets and all the other stuff that we're focusing on that has short and long-term effects, is we're managing every bloody construction job we have every day to the end to make certain it's in scope, and if we can get change orders, or if we can't, right, to fix any problem that's going to have us go over. Because if I've got the revenue, I want to generate the margin out of it. Third, bidding pipeline. Res is different than commercial. If I'm looking at commercial bidding pipeline, we know that's a bit different business than the DB design build pipeline. If nothing else, just in terms of close rates, right? I'm closing maybe 10% of bid build jobs on construction, where in residential, that number should be 5-6 times that number, depending upon who you are in the market and who the jobs are. So on commercial, to maximize the efficiency of our estimators, I would not only want to look at bidding those jobs, but also what's the likelihood of that job getting pushed? Is it really going to turn into revenue? So that means it's not just doing a bid, it's also finding out if that job is actually likely going to be pushed into 2021 or even further on out. Residential, a little bit different. I would focus on a number of different things with residential bidding now and for the fall. Certainly, and I think the same rules apply to both, which would be that for signed, in other words, signed work and contracts would be potentially associated with some price reductions to get that signed work, as well as some level of, I guess the word I'm looking for is control over their schedule, right? They get it done when they want it done at a better price. So we would do things on DB like to look back into all the jobs that were delayed, all those that we had a lead on that never turned into anything, and coming out with some marketing messages that says, listen, we're healthy, we're doing work. Here are some things that you have to take in consideration when you do a job on res, and we're doing some special pricing, et cetera, for you on your jobs. If you commit now, give us a deposit, and we'll put that on the schedule for the fall to the extent we know we can, right? I'm trying to incentivize people to get back to work. So the 2020 fall revenue forecast, in my mind's eye, becomes a really important thing to do right now to see how real that is. Lastly is, I think you have to talk to your government, your local people, right? Direct contact. I do every day. I've been through health crisis, and I sometimes know the cure is worse than the pain. I mean, worse than the disease. To some extent, that's probably happening because the virus is not equally affecting all age groups and all geographies or locations around the country. And I do think government people and the care package, which I'll share with you here in a moment, is a reflection of that they're aware of this. And then through associations, business groups, et cetera, again, right? Numbers matter when you talk to local government to talk about your pain and getting some help in that regard. Care package, right? There's a link right here to this. And it's a very large bill, but the CARES Act highlights, I'm going to point out a few. And if you're really interested, this is the actual bill. It is, I love this part. is 880 pages long. There it is. I'm sorry. I'm close to the end. You get my point. 880 pages long, right? That's the CARES Act bill. So what are some of the key highlights of this that affect you and matter to you potentially that become part of your action plan? Some of these are individually oriented, right? Direct payments, right? Americans who pay taxes receive some benefit, right, for those under 75,000 and 150. What really matters now is things like unemployment. And this is going to get a little bit weird, and we're doing some work with one of our partners, Greg Herring, and I think Greg is doing a Friday webinar on this CARES Act alone. But this is one of the weird ones, is that the unemployment package is becoming very, very generous, even to the extent that if you read into the details, you might be better off getting laid off than keeping your job, which that's a bit weird. But know that there is some backup for, and again, you saw the SBA, which is if your loan is based on your payroll, like most government programs, there are some things that contradict each other. Nonetheless, we're trying to understand this for you, right? So unemployment is going to be big. Payroll taxes, another big one. Some delay in a portion of your 2020 payroll taxes until 2021 and 2022. That's pretty good stuff from a cash flow point of view. If you're an old guy like me, you got some use of retirement funds. Here's small business relief. $350 billion is being dedicated to preventing layoffs and closures while workers have to stay home. So if you're under 500 employees, again, right, maintaining the payroll during the virus, you can receive up to 8 weeks of cash flow assistance by maintaining that. And then, of course, you saw the SBA loans and how you could use those.
Kevin, do you have a tactic so employees do approach us? They say, "Hey, Kev, I could make more money on unemployment versus sticking this storm through." Do you have any tips on how you might address that directly with them?
I don't know yet, John. That's why I'm saying we're looking at this right now to get into the details. Again, it's 880 pages, some of these details about that scenario. Again, it's a bit of a contradiction in the bill. You know, I mean, one hand, the government's working on one thing, the other's working on another. My sense, John, is if this is true, right, this one here, small business relief, right, management would be better, right, trying to maintain their payroll versus doing furloughs, right, which gets to the ABC people a little bit. You know, the thing that is a little bit harder to nail down, John, right, in our world is there's the payroll, because it peaks and declines. I mean, right now, you know, how do you define what your payroll is? Is it peak payroll, or is it low payroll for the year? Or is it average payroll, right? So I don't know the exact answer to that. And that's one of the things we're working on, John, is figure out some of this stuff. Does that make sense?
Yeah, I think it does, Kevin.
Yeah.
I'd agree with you.
Yeah, I mean, the simple answer is I don't know. By looking at the information right now, it suggests you're better off keeping people on, but then it gets down to definition of what's your bloody payroll. You know, because peak payroll is not really your payroll. That's usually a one-time aberration, right? Beginning of the year for 4 to 6 months until payroll changes again. So we have to get a little more detail into that, but it's a great question. So that link I was sharing with everybody here goes into some of the details and the highlights, as well as you can get a direct link to the details of the bill. Again, Greg Herring is doing something Friday on a webinar on the details of this. I'm hoping I might join him to go do that. And so after this webinar here today, there's a survey we want to do, because if there is information you want on more detail, and again, as I said at the beginning, this is a fairly high level about, from a business person's point of view, how one might respond to this. but we're asking a couple of questions, and we have a poll if you want to go participate in that poll. Is what other topics do you want to see for future webinars? Because we can put these together rather quickly. And it's on, do we want to do something drill down into labor, or drill down more into financial, or drill down into revenue shortfall and managing that, or rationalizing, that's a nice word for what we just talked about, an overhead, or even a federal stimulus package, right? So if you don't mind putting your votes in, that's going to help us decide what we do next. Secondly, when do you want to see this? I mean, we could do something every week, or we could do it every 2 weeks through this process. Let us know that. Let us know that also. Lastly, ask the experts. We are starting for business questions, right? Youraspire.com/best practice, right? We're starting some threads on asking the experts. And so you can start there. We're also posting on our website, and we'll do a follow-up email after this webinar today about where those documents are for the SBA, for example, for the CARES package, right? There's a number of different things that we're posting up there that would be helpful to get you there too. And then I think finally, I don't think there's a perfect answer to all this, but I know the stuff that we did when I was a consultant back in that day in 2008. And again, we had that happen in 1989, 93, 96, even to some extent, 2001, if you recall. The biggest and the severest was 2008. And the government wasn't nearly as responsive in 2008 as is happening right now. So that changes the equation a little bit. That being said, it looks to me like federal stimulus packages, people want more on financial actions. And once a week, every 2 weeks. So the vast majority would probably want something coming up next week again on this. So look for that. The reason, again, we did this is I'm a believer in the industry. I mean, we partner with our clients. We say that, but we mean it. I just like the business. I'm disappointed by what's happening right now, especially since things were so great. But it is what it is, and you know, adversity is, as they say, part of life, and it formulates what we do. And we don't have to guess. A lot of things that I mentioned today worked. You don't have to do them all, but there are parts and pieces as you formulate, right, a plan to respond to this. I'll go back to duration. This is a 2020 event, right? This is going to impact what we do until the end of the year for sure. My sense is that 2021, if nothing else weird happens, it is going to be a good recovery year because the underlying financials and economics are very good. So I hope that was helpful for everyone. We'll try and get as much of this out to you as quickly as possible. And thanks for joining us. John, anything else before we wrap up today?
Not at the moment, Kevin. Appreciate everybody coming on the call today, and looking forward to seeing you on the next one.
Thanks, everybody. Appreciate it.